Today we're diving into a topic that many of you have been curious about and have been reaching out to me to make a video on. And that's how much do you need to live off dividends? On this channel, I've made various videos that I've covered high yield ETFs, high growth ETFs, high yield dividend stocks, dividend growth stocks, and everything in between. So if we put all that together, what does it really mean to live off dividends? Because let's face it, for dividend growth investors or dividend investors, that is the ultimate mountaintop that you want to get to. Living off your dividends means that you are generating enough passive income to cover your expenses indefinitely. And you want that passive income stream to keep growing, because if your expenses keep growing, you don't have to go back to work. You want your income stream to grow either more in line with your expenses or even faster. So you want dividend income to grow faster than your expenses are rising, so you're creating that margin of error. And all that means is that you don't want to think about punching in that clock in and out, working that 9 to 5, or depending on where you work, it might not even be a 9 to 5. Maybe you're working 60 hours a week, 70 hours a week, whatever have you. And you want your portfolio to provide for you. And you don't worry about your portfolio's fluctuating value. You want to just take in that dividend stream and use that to live off of. So if that sounds like you want to reach the pinnacle of financial freedom. Let's dive right in. The beauty about dividend investing is that it offers a simple solution to the problem of how do you separate your time from your income. And that's a key to retirement, being able to buy back your own time. And that means, can you really live off dividends? First things first, what are dividends? Dividends are essentially a form of payment from a corporation, usually in the form of cash, to investors. And the reason companies pay out these dividends, it's a way to reward investors for staying invested in the company by sharing a portion of the profits in the form of those beautiful dividends. To figure out how much dividends you need to live off of, the math really isn't all that complicated. First, you have to figure out what are your annual expenses. And that means you're looking for everything from how much do you pay in utilities, how much do you pay in groceries, entertainment, internet, and everything in between that you need to live, your day-to-day life. Let's say you total up everything you spend on in a year in order to live your life. And let's say the total of all those expenses is $40,000. Well, that, my friends, is how much you need to live off dividends. Your annual expense requirement equals dividends required. I told you, it's the math isn't complicated. Now, this is where it gets a little bit interesting. Now that you know you need $40,000 in this example in dividends, well then, how much do you need to invest in order to generate that $40,000 example? A common rule of thumb used by many financial planners, financial advisors, is to take your annual expenses and multiply that by 25. Why 25? Because that 25 represents a 4% dividend yield. So going back to the example that if you're looking to generate $40,000 in dividends, because that's your total annual expenses, multiply 40,000 by 25, you get $1 million. So that means you need $1 million invested, generating 4% yield, which spits off $40,000 in annual dividends, which you use to cover your $40,000 in annual expenses. According to a recent report, the average median household in the United States needs about $1.7 million invested to live off dividends. And that $1.7 million assumes you're earning that 4% yield and your annual expenses are roughly $67,500. So if you're like me, you're probably thinking $1.7 million, $67,500, 4% yield, $40,000. That's a lot of numbers to throw at you, and maybe it hasn't digested just yet. I'm a visual learner, so what I've done is I've created a heat map for you to really drive this concept home. Let's take a look. So what I've done here is I've created this table that shows you, okay, your annual expenses is what we know equals dividends required. And I've created 3 different categories. Your annual expenses, $40,000, $50,000, and $67,500. On this side, that 25%, that rule of thumb we just talked about, which is equal to that 4% dividend yield, well, I've given you an array of options because for some, 25 may not be enough. You may need to go lower or higher based on your personal situation. And personal finance is exactly that. It is personal. So not everybody can work with 25. For you, maybe 22, maybe 28, or maybe somewhere in between. but at least now you have an array of options to work with. Each of these numbers here represents the yield required to generate the investment. So for example, we just talked about how if your annual expenses are $40,000, you would need at 25 $1 million invested, earning 4% to live off dividends. In the other example, the average home in the United States needs about $1.7 million, meaning their annual expenses is $67,500, and at the 25% or at the 25 safe withdrawal rate, which is a 4% yield, that equals 1.7. Well, what if we take that same $67,500 expenses? What if you can get a yield of 4.55%? That means you only need less than 1.5 million. That's less than 200,000 of additional capital you don't need because you can generate a higher yield. Conversely, if you can't generate that higher yield, maybe your yield is at 3.57%, that means now you need $1.9 million versus the 1.7 or the 1.5. So compared to this scenario, you were looking for an extra $200,000 of capital invested. But what if you don't need all that much to live off of? What if you live a more of a modest lifestyle, or you just don't have as many expenses because you live in a lower cost of living city? So if you're at $40,000 of annual expenses, again, this represents how much dividends you need. We're just trying to solve for how much do you need to invest in order to cover your dividends off your annual expenses. So at $40,000, if we assume between 20 to 28, which represents a dividend yield of 3.57 to 4.55, you either need $1.1 million or less than $900,000 in order to live off your dividends. This is something you need to figure out, as well as this. Once you have these two variables figured out, the math here can guide you in terms of how much do you need to invest in order to live off your dividends. It's super important that you pick companies for your portfolio that have a solid track record of not only just paying dividends, but also increasing dividends. Because in that example we just talked about, let's say you can earn $40,000 in dividends. But what if your expenses, start off at $40,000, but they go to $42, $45, $50, and your dividends stay at $40? All of a sudden, you now have a shortfall where you have to figure out, okay, how do you get that extra cash to cover your expenses? So in order to avoid that, what you need to figure out when you're selecting your dividend-paying companies is look for stable earnings, look for low debt, look for a strong commitment to sharing profit with shareholders. Now, you have a couple of options here. You can either handpick individual companies and build your portfolio together, but there's a little bit of risk because what if you don't pick the right company? The other option is you can pick a dividend-focused ETF or a broad-based index fund ETF. The benefit about going the ETF route is that it allows you to be hands-off. You can be hands-off with a dividend-focused ETF, where the ETF is doing all the hard work for you and selecting and screening the companies that generate a good dividend for you to get in your pocket. Or you can go with a broad-based index ETF, which pretty much gives you the entire slice of the overall market. As we saw in my example, the higher your yield, the less capital you need invested in order to cover your expenses through dividends. Now, while dividend strategies are great for this type of approach, the problem is when you get tempted by high yield stocks because you're trying to get as much yield as possible with as little capital as possible. And that can get you into a bit of a risky and dicey situation. High yields often signal that a company might be facing a challenging time, whether their business is in decline. Maybe their products are just not getting the same value proposition as they used to. That could lead to that company cutting its dividend. If that company cuts its dividend, that means one of your income streams has not been completely cut or eliminated, and that means the value of your investment can drop, meaning you're losing a chunk of your income stream. As I said before, if you're at neck and neck with your dividends income and your annual expenses, if you lose a chunk of your dividend income or your expenses are growing higher, if that margin increases, you have to then figure out an alternative form of cash to cover your investments. Or worst case scenario, then you have to go back to work, which may not be appropriate depending on the stage of life you're at. Instead of just blindly chasing yield here, what I want you to do is do thorough research. Make sure you thoroughly vet the company that you're picking that can offer a reliable dividend. Is that reliable dividend able to grow, or do you see a foreseeable risk where that dividend may need to get cut? Common approach is to look at the payout ratio. If that payout ratio is close to 100%, That means the company is taking all of its free cash flow, all of the profits it generates, and just paying out to shareholders. It doesn't have any leftover to grow. That might not be a bad thing, but again, you have to do your research, your due diligence to understand, is there a risk where that dividend can get cut? So you want to make sure you diversify your portfolio. What you want to ensure is stable and long-term earnings prospect. And it's actually another reason why I recommend ETFs as opposed to picking dividend stocks, because the ETFs are doing the heavy work for you and they minimize this risk of you just picking a bad company that may cut their dividend. Another common trap for dividend investors is hindsight bias. It's easy to be attracted to companies that have been upping their dividends for a long time. For example, if you look at the S&P 500 dividend aristocrats, they've been upping their dividends for 25 years. And because they've outperformed the market, they've provided those consistent dividends, a lot of people get attracted that, you know what, they've been growing their dividends for 25 years, they'll probably continue. And that's where the mistake happens. You don't want to assume just because a company has been growing their dividends for 5, 10, 25 years, that they'll just keep on growing without having to understand what their underlying business is. Because paying and growing a dividend for every company for multiple years is not a sure thing. A company's business could be shrinking, but because they want to maintain that allure of dividend growth, they can still offer a growing dividend. All the meanwhile, their cash flows are shrinking. And then what happens, as I mentioned about the last part, dividend cuts, right? That's what you want to avoid. Take, for example, the financial crisis. Out of 60 dividend aristocrats, 17 of them cut or eliminated their dividends altogether. And if you were one of those unfortunate individuals that was relying on, let's say, 20 companies, and out of those 20, you had 17 that cut their dividends, you lost a big chunk of your dividend income stream because of that selection bias, because of that hindsight bias. Now, that doesn't mean that dividend investing is a bad strategy. What I want to show you is that it's crucial to select companies with strong balance sheet, with strong business fundamentals, and track record of success. Because the businesses that are more likely to survive and thrive during different economic climates, those are the ones that you can count on to have the right management in place so they can navigate different economic conditions. As I often say on this channel, past performance is not an indicator of future results. So you have to do your due diligence, really understand, are the companies you're picking, will they still be there in the next 20 years, 30 years, or will you have to shift your strategy based on how different economic conditions play out? The final trap for dividend investors I want to focus on is those dividend investors who focus too much on the income side and forget about total return. Just because a company pays a dividend doesn't make it better than a company that's not paying a dividend. And just because they're paying a dividend doesn't mean they're going to pay that dividend indefinitely. Companies have cut and have eliminated the dividends when business and economics change. That's the reality of investing. So then what do? How do you navigate your retirement if you're worried about your dividend-paying companies cutting or limiting their dividends? Well, in theory, your retirement should come from multiple income streams. What do I mean by that? Well, you can generate income from cash. You can generate income from bonds. You can generate income from dividends. You can also generate, and this one is what people miss out on, you can generate income from capital gains. That means selling parts of your share or portions of your shares or ETFs at the right time to generate income from capital gains. Those shares are for you to use. If you have to sell them to earn income, that's not a bad thing. As long as you're focusing on total return, selling shares can be equivalent of pretty much creating your own dividend. But from a behavioral standpoint, dividends are just more comfortable. And I get that because you don't want to sell your principal that's generating income because the market might be going up and down. So there's just that inherent comfort, psychological benefit of, I'm not going to touch my principal. I'm not going to kill the goose that's laying the eggs. I'm just going to keep eating those eggs. So yes, there are arguments for and against dividend investing. And some may argue that, you know what, if you're okay selling shares for capital gains, that's fine. And if you want dividend investing because you prefer that psychological comfort, that's okay as well. Just understand the pros and cons of each strategy and what makes sense for you and what will keep you calm throughout all this. Managing your retirement can feel overwhelming at times, and I get it. It's a scary or frightening concept to think about. I have to look out for myself 30 years from now, so I have to make sure I make all the right decisions so I'm not going hungry 30 years from now. That means you have to make decisions based on your financial goals, your risk tolerance, your investment time horizon, your quality of life expectations. There's just so many variables in play. So what I want you to do is take away these 3 key things that I'm going to talk about next to help you navigate that no matter where you are at your financial journey. First, I want you to focus on quality. You're going to prioritize companies with strong balance sheets, with a history of sustainable dividend growth to ensure a reliable income stream. Or if you prefer a more hands-off approach, look at dividend-focused ETFs or broad-based index funds. Next, you're going to diversify, and that means you're going to spread your investments across multiple sectors, multiple geographies, multiple asset classes to mitigate the risk and enhance stability of your portfolio. Third, last but not least, you're going to stay disciplined, and this is the key foundation that pretty much underpins it all. Stick to your strategy and avoid making impulsive decisions just based on day-to-day market fluctuations. What you want to ensure is your long-term financial stability. If you have questions on anything I've talked about, anything at all from this channel, from this video, I want you to drop your thoughts, your comments down in the comment section down below. Or if you prefer, you can reach out to me privately on askme.com and ensure a quick private response directly from me within 24 hours. Don't forget to hit like, subscribe, and thanks on the bottom of this video, because that's my indicator that you like this video and you want to see more content just like this, so I can make more content just like this. That's it for now. I'll talk to you in the comments section.